Hi, everyone. Welcome to the JD Power Insurance Intelligence Podcast. I'm Michael Vermillion with JD Power, and with me today are Steve Crewdson from the insurance practice. Hi, Steve. Thanks for joining.
Hi, Mike. Glad to be here.
We also have Craig Martin from the insurance practice. Craig, thanks for joining today.
Yeah, my pleasure. Thanks for having me.
And then also special guest Ken Lee, who's our on-call data scientist working with the insurance practice here at JD Power. Ken, thanks for joining today.
Hey, Mike, thanks for having me.
So the topic we want to dive into today is around customer acquisition, and specifically on the topics of prospecting. And the context here is that we are exiting a hard market. We're seeing kind of new levels of activity in terms of shopping and switching and so forth that we'll get to in a second. We're seeing premiums kind of coming back down a little bit in some cases, which is creating kind of more competition. So the question we want to address today is, as we're exiting this hard market, we're seeing more competition. What steps should carriers be taking to hit their growth goals moving forward? So, Steve, why don't we start with you? What is happening right now in terms of the state of shopping?
Yeah, so that's really kind of ties together a lot of what you were talking about, Mike. We're exiting the hard market, rate activity is calming down. So if you look at the industry data, rate activity in December of last year, just 2 months back, was down in the low single-digit average increase across auto insurance premiums. So back to basically historical norms after 2+ years of extremely elevated rate taking. What we've seen consumers do in response is they spent the second half of last year, as rates were coming down, they spent the second half of last year shopping more. So we saw in Q3 and Q4 in our list report what were to date at that time record shopping rates for auto insurance. So far in Q1, we're only about halfway through Q1, just a little bit over that. We're seeing by far an all-time new record for shopping for auto insurance. So by way of example, Q3 and Q4 of last year, we had a 13.2 and 13.3% shop rate. Thus far in Q1 of this year, we're at 13.9%, so a highly elevated shop rate. What's interesting, though, is in the second half of last year, something rare happened. That as shopping went up, so too did switching. Usually you'll see them move in opposite directions, whereas you get more people shopping, a smaller share of those actually switch because you're getting some of the less serious shoppers to come out to market. And when the shopping rate goes up, the people that were really intent to switch, they were shopping anyway, right? So when the shopping rate goes up, it's kind of like the softer shopping is happening. But we didn't see that. We saw as shopping went up, switching went up. This quarter so far, we're seeing as shopping has skyrocketed, switching's come down a little bit. So it might indicate that it's becoming harder for the people that waited to get out and shop to get that lower premium. There's a lot of possible hypotheses there, but it looks like some of that pent-up demand to switch worked its way through the system in the second half of last year, and it might be a little bit harder for those that are out shopping now to find that more competitive premium because the switch rate is coming down. But this is kind of a normal cycle coming out of a hard market. People had seen their increases in their premiums. They look, as the market softens, to find a lower premium. So I think we're going to see here for at least a few months, maybe even longer, into Q2 and beyond in 2025, an elevated shop rates where people are looking to find that lower premium. And as we're talking about growth today, in our industry, growth is always a function of three things: acquisition, retention, and share of wallet. So we're seeing the acquisition story play out. Carriers are increasing their ad spend. They're getting back into opening up sales channels. They're trying again to acquire customers. What we also think is going to be a renewed focus on retention. So carriers have spent the last few years improving their underwriting, reaching rate adequacy. I don't think they want to lose all that many of the profitable customers that they won over the last few years. So retention is going to come back into play. And of course, as goes customer satisfaction, so too goes retention, acquisition, and share of wallet. So carriers are going to be refocused again on growth, and that's going to require to pull the levers on acquisition, retention, and share of wallet.
Yeah, thanks, Steve. I'm glad you kind of brought us back to kind of the big picture in terms of growth and growth drivers. So, yeah, the way we think about growth here at JD Power, it really kind of begins with really understanding your strategic goals, especially in terms of the type of customer that you're looking for. So, who do you want to target? What's your target market? And then from there, we want to get at of the people who are shopping who are most likely to switch over. We're going to touch in a minute this idea of once we figure that out, how do we then screen or identify the customers that would be most profitable or kind of fit your ideal customer profile. And then we also want to touch a bit about on how do you then convert them. But Ken, kind of going back to this idea that a lot of people are shopping for insurance, how can we use data science to kind of better understand who these people are and really kind of better understanding their propensity to actually switch carriers?
Yeah. So I think it's a really interesting time right now because we're thinking about kind of human behaviors and behavioral data and using that to predict what people are going to do. But kind of taking a step back first, like historically, kind of pre-big data, one of the biggest arguments that came up in the social sciences was measurement versus bias. So you had a lot of psychologists that were really focused around having really good measurement, making basically saying like, are we capturing things the right way? And then on the flip side of that, you had a lot of economists that were very focused on bias. So even if we can measure things well, is the main thing that we have the main predictor, or are there some other things at play that we can't really capture? So if we think about, let's say, like a marketing pilot, you had psychologists that were going to say, oh, did we design it correctly? Are we targeting the right people? Did we implement it the right way? Does it work at scale? Does it work for a small group? And then for economists, the flip side of that is, hey, like even if we design it, if it is a marketing pilot, is it because of the marketing pilot, or is there some other sort of market activity that's happening that's pushing people to move over? What are the behavioral responses that matter? Is it because of this marketing pilot, or is it just because, hey, people just like, is there crowding out behavior? Is there strategic behavior? Is there a spillover effect? So all these different components come into play when you're thinking about something as simple as a marketing pilot. However, what I saw and what was really interesting was like as we're having this fight, this is when big data started emerging, and it was like, hey, we just need more data, and that's something that both parties can agree to. And more data meant that you can have more complex models, and that's kind of for me like where it really took off. And combine that with the like how technology has evolved and how it kind of increased and getting closer and closer to the edge of Moore's law, these capabilities kind of all came into play. So effectively, that argument of measurement versus bias just kicked the can down the road. And more of these like machine learning techniques came into the foray. And what's happening now, especially in the world of like behavioral predictions, is that we're kind of getting back to this original argument of measurement versus bias. And that's spurred on by a few things. Number one is from a policy side, you have things like CCPA, you have GDPR, and just generally, you're seeing people just get creeped out a little bit more in the market. So you're seeing things like Instagram ads, and you're like, wait, like, why am I looking at this? Why am I doom scrolling forever? You're looking at YouTube algorithms that are saying like, hey, look, like, you're going to watch this next video. And over time, you're like, why do they know this? Why do they know, like, and it creeps people out over time. And with these policies, now that you're no longer able to kind of store these cookies that predicted what you did in the past, it's a lot harder to predict now what people are going to do in the future. And then on top of that, all these data scientists are now coming to realize you can't really measure everything and you can't capture everything. So one example that I always like to say is, if I had a room of 10 different people and I asked 10 different people, what is love? What is your definition of love? I can guarantee you'll get 10 different answers. And each of them, people will nod their head to in agreement for. So basically what's happening now is we're kind of transitioning now from more advanced models into incorporating more of the traditional statistical models. Basically, they've always worked. 2, you can explain them really well. There's no black box methodologies. You don't know why things, like you can explain it. And three, they scale really well. So as you kind of repeat these over time, as you bring into a bigger audience, they really work. However, what that means is that in order for these models to work, there's now a bigger focus around good, unbiased data. With all of these policies that are coming into play with CCPA and GDPR, as people kind of elect to not provide the cookies, you're having more and more biased data. And as you have more biased data, that actually changes the models and changes your predictions in the wrong way. With more of a focus around good data, now you're seeing people kind of combine classical modeling techniques with kind of these advanced methods. So it's a really good kind of synergy between the two. And I think insurance carriers now, especially as you're thinking about what people are you going to get, the bigger focus now is going to be around where can we get the best unbiased data that's going to provide us the foundation for all these really good models moving forward.
Thanks, Ken. So we know there's a large population of people who are shopping for insurance. We know that we can use data science to understand intent. We can use data science to understand propensity to switch. But in the end, we still need to bind policies in order to grow, which means that we need to find prospects that are not only likely to switch and have intent, but also meet our underwriting guidelines. So how do we connect those dots? Steve, maybe start with you.
Yeah, Mike, it starts with realizing that not every carrier has the same target customer. Not every carrier or insurer has the same underwriting guidelines. So really looking at the individual insurers, where they are, meet them where they are in terms of their underwriting criteria. And even in some cases that can vary by region. So the best models moving forward are going to be those that help the clients, the insurers at the level of analysis they really need. So whether it's a state level or regional level, or even in some cases maybe a national level, to find what's the right customer for them. Because the next insurer might have a very different customer that's right for them, and maybe in a different region has a different type of customer they're acquiring and want to acquire. So a model that overlays, as you were basically alluding to, Mike, not just this person is going to shop, so attract them, but this person is going to a shop, they're in this region of the country, and that's the type of customer you want to acquire in that region. Layering in those second and third levels are going to be what differentiates performance in the acquisition models moving forward.
Yeah. Thanks, Steve. So Ken, underwriting guidelines, it may involve demographic data, but in many cases, it may also involve behavioral data, right? So really kind of understanding the driving history, for example. So from the data science point of view, how do you think, as a data scientist, how do you think about incorporating not only the demographic data, but also the behavioral data into your models?
So for me, I'm thinking just generally across carriers, what kind of data that they may have. And I think every carrier should do a really hard, strong look, a very unbiased assessment of what data that they have. And consider, just from an overall customer perspective, what are some of the major components that might get someone to switch over? And are you capturing that the right way? So for example, a carrier may have information about event level data. What kind of, let's say I changed prices for a customer. This person had a certain claims experience. Do I have information about what kind of advertisements that they've interacted? Do I have information about something about, let's say, their personal character or the personal kind of livelihood? Did something change in their family? Did any event sort of happen? Are there any geopolitical, maybe macroeconomic factors that come into play as well too? So I think carriers should, these modeling things, like everyone has a capability now to do this well. I think every carrier now needs to do a really strong assessment of the data that they have, the data that they don't have, and then get a good sense for, okay, what do we need to do next to make sure we fill in all these holes the right way.
Thanks, Ken. So Craig, we know there's a big population out there shopping. We have talked about how to identify the prospects that look like the customers that we want to have in terms of intent and propensity to switch, and even meeting our underwriting guidelines. But in the end, we got to get them over the goal line, right? We have to convert those prospects. And you do a lot of work with agents. What should carriers be thinking about in terms of how to improve conversion rates once you've kind of invested all of this effort and resources into finding the best prospects?
Yeah, I mean, I think a lot of it comes down to all these points are critical is how do you put that into practice? That pull through is not just you've identified the need, you've understood the problems that they have, and maybe what the barriers are to switching. But are your people trained to effectively address those, discuss them with the client, and then present a solution to demonstrate why it's worth the effort? I mean, that probably one of the bigger factors. I mean, Steve mentioned this earlier. A lot of people shop, but then they stop. So what's holding them up? Is it purely a price game? Is it, hey, you've increased my premiums? If it's strictly, hey, the premiums are the same, I'm not going to switch. Well, there are other factors. There's lots of detail underneath that. How do you have a meaningful discussion that uncovers that need and kind of addresses or puts to bed someone's concerns about switching, the effort, the time, the energy? How do you overcome those things? Because you put a lot of money into marketing, into targeting, and get these prospects to the door, and then you can't pull them through. So how effective your agents are in particular is a really critical piece. I mean, that's a lot of people want to go to an agent. They want to talk to them to go through that process and understand it. And if it's, if I'm shopping online or just at a basic level, I've got basic facts, but my emotions start to come into play. I use an example of my father. He's been with his carrier for 20 plus years. And I told him, I guarantee you can save money. And he's like, yeah, but that's a lot of work. That's a lot of time and energy. I'm not doing that. And it's shocking to me. I'm going, hey, it's not that hard. But again, you got to overcome those barriers. Even though he's gotten, lots of increases, he doesn't, he feels like he's a good customer, but yet doesn't get that in return. But nobody's come to him and say, we can do better. So I think that's that critical kind of final leg of moving from prospect to new client.
Yeah, thanks so much, Craig. So we're just going to finish up. Let's recap the growth playbook that we walked through today. So first, you want to start by understanding what your strategic goals are and making sure those are aligned across the organization. Really understanding who you want to target, what your target market is. From there, identifying within that target group who are most likely to switch over, who have intent, and even understanding what marketing messages would really kind of catalyze or would resonate with that group and catalyze action on their behalf. And then from there, making sure that the prospects you've identified fit within your underwriting guidelines and they're the profitable customers that you're looking for. And then finally having a solid action plan around conversion and making sure that your organization is equipped to make that happen. So Steve, Craig, and Ken, thanks so much for taking the time to join us today. I thought it was a great conversation.
Yeah, likewise. Thank you, Mike.
Thanks, everybody. Appreciate the time.
And we want to thank our listeners as well, and we'll see you next time.